So many familiar faces. Welcome to the International Banking Research Network session on non-bank financial intermediaries. And so we'll start with the anatomy of a liquidity shock.
Thank you, Linda. Setting the timer. Okay. Good afternoon, ladies and gentlemen. I am Sonalika Sinha from Reserve Bank of India. And this is the title of our paper, Anatomy of a Liquidity Shock on Non-Banks. And I first of all must thank the CEBRA and IBRN for giving our paper this opportunity. This is rather preliminary work co-authored with Dr. Nirupama Kulkarni from CAFRAL and K.M. Neelima from Reserve Bank of India. I must also add that the views expressed in this paper are personal and do not represent the institutions that they come from. Okay, so very quickly getting into the motivation, here's why we decided to do this paper. We know that maturity mismatch is an inherent feature in financial institutions. For banks, the asset liability mismatch does have some support from deposit insurance schemes and lender of last resort sort of facilities. But on the non-bank front, while there exists the similar kind of asset liability mismatches, there tends to be lighter regulation on the non-banks with no deposit insurance or lender of last resort facilities. So we know about the effects of the shocks that occur to traditional banking sector, but we know less about the shocks that impact the non-banks. And so that's what motivated us to think about these issues. So why should we care? Non-banks primarily contribute to one, facilitation of monetary policy transmission across financial intermediaries. And that is if the interest rate spreads remain stable. And so there's a ton of work by Briukhova talking about the need for stability in interest rate spreads to ensure that monetary policy is transmitted smoothly. And the second and probably most commonly understood reason for non-banks is, of course, financial stability. And we have seen an increasing share of the non-bank credit share in total financial assets in India as well as globally. And of late, it has started attracting a lot of foreign investors through cross-border flows. So giving you some context of this is the cross-border flowing into the Indian economy for non-banks as well as banks. And you see that they're often competing with each other. In fact, from 2013, the cross-border inflows into the Indian economy for non-banks has actually exceeded that of the banking sector. So this is quite a lot of reasonable reason for us to look at how non-banks behave, particularly in response to shocks. So in this paper, we are looking at a liquidity shock that occurred in September of 2018, when a large non-banking financial company, which I will call as NBFC, defaulted on its short-term debt obligations. And as a consequence, the mutual funds, which basically comprise 60% of the short-term commercial paper market, started pulling out because they felt redemption pressure. And as a sub-consequence, the non-banks which were relying on the CP market or the commercial paper market found it difficult to switch to alternate sources of financing in the short run. So that's basically the shock that occurred to the non-banking sector in India. So here are the research questions. We studied the effects of the liquidity shock of September 2018 on one, short-term funding, wherein in the first order effects, we look at the impact on commercial paper funding. And as a second order effect, we look at the impact on bank or bond market funding in the short run. On the asset side, we look at the impact on credit and investments of these non-banks. And then we also get into larger questions like what sort of spillovers does this shock have on, let's say, does it have contagion effects? What happened to the traditional banking sector? And then potentially some real effects, like what happened to the borrowers from these non-banks at the firm level. So what's critical here is the identification that we use in this paper. We are exploiting an ex-ante heterogeneity of less than 1 year because it's a liquidity shock. So we're looking at heterogeneity in less than 1 year liquidity exposure to rollover risks that made certain NBFCs more susceptible or more prone to the shock as opposed to the other non-banks. So here's the key insights of the paper. And if you listen to nothing else, please pay attention to this slide. In response to the liquidity shock that occurred in India, the commercial paper funding declined by 14.5 percentage points for non-banks, but for the ones with higher ex-ante exposure. And this was attributable mainly to the fall in the commercial papers subscribed to by the mutual fund segment. We also find that larger NBFCs, which also had higher exposure to these rollover risks, were the ones to be more affected. And there was no, in fact, there was no effect of the operating efficiency, but size and exposure did have a crucial role to play. Our second finding is that high exposure NBFCs could not make up for the decline in the commercial papers with alternate sources of financing in the short run, like banks or debentures. The next thing we find is that the non-banks, for a subset of 57 non-banks, which constitute 85% of the market, we see that the bank lending to these non-banks actually ring-fence themselves, and they continue lending only to the healthy non-banks, but step away from the unhealthy non-banks. As far as credit allocation is concerned, we see that in response to the liquidity shock, the credit actually from the non-banks comes down across sectors. However, there is no impact on investments. And finally, we see that high exposure NBFCs or non-banks actually tend to pass on their credit constraints to the borrowers in the short run. So that's the paper in the nutshell. Now, very quickly running through the literature, broadly, we hope our paper can contribute to two strands of literature. The first is to understand the mechanisms of the shocks that happen to the non-banking sector, to look at short-term effects like lending, investments, consumption, and there's a ton of work in this, and also some potential long-term effects, which would include capital reallocation and some real effects as well. And the second strand of literature we hope to contribute to are the cleansing effects of a shocks to banks and non-banks. So while we know a lot about the allocative efficiency of what happens to a shock for the banking sector, we know less about what happens to the non-banks. And we also look into the bank-non-bank relationships and how that tends to change or respond in response to a liquidity shock. So now getting into the institutional details of non-banks in India, because I think that's very important to understand this paper. The non-banks, of course, hold a significant share of 0.4 trillion US dollars as of March 2022. And the credit to GDP ratio of this sector increased from 8.6 to 12.3% over the past decade or so. And the share of non-banks in bank credit increased from 15 to 25% over the past decade. So now, non-banks are classified based on their liability structure. That's one way of seeing it, and also on the basis of their nature of activity. So on the basis of their liability structure, we have deposit-taking non-banks, which are very few in number. And then we have non-deposit-taking non-banks, within which we have systemically important ones and not important ones. So that's the broad structure of how the non-banks operate in India. And in terms of activities, we have the top three that constitute investment and credit companies. These are the asset finance companies, the investment companies, and the loan companies. So these constitute the ICCs, which basically are in the business of providing finance. So a lot of our focus is going to be on these top three sectors, which we call as ICCs. So the share of non-banks in the short run is primarily, the CP market in the non-banks is primarily held by the mutual funds sector, which on an average holds around 60% of the commercial paper holdings in the non-banks. So this is important to understand as we move forward. So to tell you more about the liquidity shock, as I mentioned, it happened in September 2018. It was a debt of 91,000 crores, out of which 57,000, which means much more than 50%, was lent by public sector banks. So this could have had significant financial stability risks. As this default happened, of course, it raised a lot of concerns among investors, and this was followed with a rating downgrade, causing a massive sell-off in the market. So as mutual funds faced redemption pressure, they started to pull out of the commercial paper market. And after that, the NBFCs also faced significant hike in their spreads, because borrowings became more expensive, basically. So this is the chart of the spread of the non-banks, and you can see that there was a spike around the 2018 period, and basically the cost of borrowing short-term really went up. And also in terms of the term risk premium, that became very unstable. And across maturities, 1 month, 2 months, 6 months, or 12 months, there was a lot of instability. So, there's enough reason for the regulator to be worried about this. So now getting into the data, which I think is the real hero of this paper. We've had the opportunity to get access to supervisory reporting of entity level information on these non-banks. So we're looking at 332 of these, which are ICCs, investment and credit companies. And so we collate information from these platforms called Cosmos, Business Objects, and XBRL, which are Indian supervisory reporting platforms. And so the data is quarterly, and we look at the pre-period. And so we are using a classic difference in difference methodology, in which our pre-period is June and September 2018, and the post-period is December and March 2019, December 2018 and March 2019. So we use this information and match it with the supervisory bank balance sheet information, that is the scheduled commercial banks, which are lending to these non-banks. And then we also match the other end, in which the non-banks are matched to their top 20 borrowers, right? So we have the banks lending to the non-banks and the non-banks lending to individual borrowers, right? So we have the entire lending channel, and I think this is a really rich data set to work with. So now getting into the empirical setup, basically, like I said, the major identification revolves around ex-ante exposures, which we calculate as a difference of contractual inflows and outflows to the total outflows. And basically firms with below median ex-ante exposure, basically the ones that faced more outflows were below median, and we are categorizing them as high exposure firms. And the ones with above median take the value of 0, and they are less exposure firms. So we take a dummy variable for the exposure. And we basically want to exploit the ex-ante exposure to the rollover risk that materializes during the liquidity shock that occurred. So very quickly, before I get into the main results, here's the correlation table of the ex-ante exposure, and basically trying to see if any non-bank characteristics have an impact on the ex-ante exposure, and we find that there is no discernible impact. So we have a fairly endogenous setting of the ex-ante exposures to go with. Sorry, exogenous. And coming to the empirical specification, so delta yi is basically the dependent variable, which looks at the change in borrowing or lending of these non-banks based on the average balance sheet for the pre and post period. And on the right-hand side, we have the ex-ante exposure, like I just explained, where beta is the coefficient of interest, which measures the effect of the shock of non-bank borrowing or lending for the higher ex-ante exposure firms relative to the lower exposure firms. And XIT is, of course, a bunch of non-bank characteristics like NPA ratio, operating expense ratio, and cash ratio. So this is the basic empirical framework that we work with. So here's the preliminary results of the paper. We look at the growth of the commercial paper market that actually declined for high exposure NBFCs by 14.5% in response to the shock. Within this, the results were largely driven by decline in mutual fund lending to the short-run market. That's 10.6%. So this is a pictorial representation in which we basically see that the high exposure firms, which are orange in color, have an immediate decline in their CP funding in response to the shock. So just to corroborate our results, we also do a placebo test in which we give a random shock to the same setting, and we find a null effect. So we are very sure that it was in fact this liquidity shock that caused these results to occur. Thereafter, we look at a lot of heterogeneity in the non-banks, like we look at size, provisioning ratio, operating expenses, and we see that larger NBFCs, which is the first column over here, they are the ones to suffer more in terms of decline in the commercial paper growth. And the provisioning ratio is also an important feature. That means firms which had higher exposure but had adequate provisioning buffers did not suffer as much. So that's probably a good regulatory outcome as well. Then we look at the impact on alternate sources of funding, whether the non-banks were able to access alternative sources of funding if they were falling short on the CP market. And so we look at debentures and banks. And so the decline is not just in the CP market, but you see the similar decline, more sizable in fact for the debentures and banks, because of the sheer size of holdings that they have in the short-term market. So it really was a confidence crisis where non-banks lost out on all the short-term funding facilities that they could. And then, okay, so this was the banking result. And so we just dig deeper into this to look at what specific channels from banks actually played out or didn't play out. So we look at term deposits, working capital, cash across all products. The banking sector seemed to want to step away from the non-bank funding, right? So there was a broad-based outflow from the banking sector. So this is what we get at an aggregate level. But what we want to do is also drill down into the banking sector, because we want to make sure we understand the contagion effect from the non-banks to the banking sector. And so what we do is, so we look at within firm variation. So we have more information on specifically 57 non-banks, which are now not limited to only the ICCs, but across all the activities of non-banks that I showed earlier. And so we look at 57 of those which have financial institutions lending information. And so these account for almost 85% of the market. So this is a very representative sample. So then when we look at heterogeneity by banks and non-banks, so here's a fixed effects for the financial institutions, and we see the effect for the banking sector. It is actually showing a slight increase by banks to the non-banking in response to the liquidity shock. So if we drill this down further, we see that this increase is actually for the healthier non-banks, that is the non-banks with below median NPA ratios. Those were the ones to which the banks were continuing to support lending facilities, but to the unhealthy non-banks, there was no, they didn't want to do much with them. So basically, even though banks continued to provide some sort of lending support, it was only to the healthy non-banks that. Okay. And then we look at impact on credit and investments, where we see that there was a massive decline in credit, of growth in credit of these non-banks, especially of the ones that were high exposure, that declined by 32%. However, there was no impact on the investments, which are the rest of the three columns. And digging deeper into the sectoral credit, we look at different sectors like retail, industry, and services. And we see that the decline was across all sectors, but highest decline for the retail sector, and then followed by services and industry in response to the shock. So basically, the firms with higher exposure cut down on their lending to the retail sector the most. And the reason, we're still looking into this, but one of the reasons we think is because retail has shorter maturity periods. So that may be difficult for non-banks to generate that kind of capital to continue allocating from the pre-shock period. And then we look at on the supply side, like how much the NBFCs continue to lend to the firms, and we basically look at the total firm borrowings in response to the shock, and we find that the firms with higher exposure actually cut down. So this is the second column, which is a borrower fixed effect. So they actually reduce the lending to the individual firm borrowers. And so basically the high exposure non-banks actually cut down credit. So there's reason for us to believe that there is some amount of credit reallocation that is happening in response to the liquidity shock that occurred. So hopefully I'm in time to sum up. Okay, great. So basically here's summing up what we've found so far. The non-banks with higher ex-ante exposure or higher exposure to rollover risk were the ones to suffer most from the liquidity shock, as they were unable to make up for the shortfall in their funding requirements. And moreover, they were also unable to access alternate sources of credit in the short run. Banks, the traditional banking sector, tends to ring-fence themselves from the non-banks in the event of a liquidity shock, but they continue to support the healthier non-banks. And at the sectoral level, the non-banks actually cut down their credit across sectors. However, the investments from the non-banking industry are not so much impacted. And finally, the high exposure NBFCs, non-banks, actually pass on their credit constraints to individual firm borrowers. So here's the mechanism of how a non-bank responded to a liquidity shock in India. And we're very happy to have Björn and your questions then. Thank you.
Thank you. How many did
I was 19, yeah. I'm watching. Thank you.
You still have to listen to speaker.
Yeah, but I don't know if it's working.
Yeah. So yeah, let me thank the organizers and especially Linda for letting me to first read and also discuss this really interesting paper. And I think it's really amazing source of data, and it helps us to much better understand how non-banks respond to liquidity shock. So I think Sonalika did a great job in summarizing a paper. But maybe you were a bit tired after lunch. So let me summarize everything on one page here. So what the paper does, it looks at the impact of a liquidity shock, and here they look at the default of a subsidiary of a large non-bank financial institution, which then result in a downgrade and further fire sales on short-term assets. And the paper finds that when you have a non-bank financial institution which has a larger exposure in liquidity risk, they decrease their borrowings on the one hand in short term, so they get less funds from mutual funds, they get less funds from banks for long-term funding, and then on the other hand, they see that, however, healthy non-bank financial institutions receive more bank funds. And then they look at the distributional effects, so the transmission to the real economy. So NBFI with larger exposure to liquidity risk, they decrease their lending, and especially to retail customers. So overall, the paper concludes that that the credit constraints in a non-bank financial institution has an effect on, it also depends on NBFI health, and also transmits to their borrowers. And I think we all are aware that non-bank financial institutions are very important. So looking just in the case of Europe, by now, I just saw a presentation last week from the ECB, which said that 25% of lending to non-bank customers are by now done by non-bank financial institutions. So it's a strongly increasing market and becomes more and more important. It's also, therefore, I think like the non-bank financial institutions and how they transmit shocks to the real economy is an absolutely vital question. And so therefore, I applaud the authors to have a look into this and to furthering our understanding in that part. I think it's still at an early stage, the project. So most of the things will be like, write more, explain more, as you'll see in a second. I want the authors to think more a bit economically implications. The description of NBFI wasn't entirely clear. How does the liquidity shock work? Or do you actually want to call it like shock? I'll come to that. And what's the unit of measurement, which is exactly used in the paper? So first, let me talk about the economic implications. So what you show is that institutions which are more prone to a shock suffer more when the shock occurs. That makes a lot of sense to me. So I think what the paper shows is that the market is efficient. Everything is incorporated, information is incorporated in the market. And on the other hand, you then have the question, why would I not expect that result? So what are the frictions we're actually interested here? I would like you to carve this out more. If you like coming from banking, like banks have retail customers, so all little people should be protected. So we have deposit insurance. Then they're systemically important, so it might have an effect on larger economy. But here, who's actually hurt when a non-bank financial institution fails? It's actually, it should fail if it's not really vital, right? And don't get me wrong, it's really important to understand the overall mechanism and then to carve those out. But please read more to literature. And you did much more on the slides than is currently in the paper. I saw that immediately. And as I said, it's an early draft, so of course, and there you should write much more and like relate it to the different parts as you did on the slides, for example, and then describe the overall economic implication more detail. And then what do you add to literature on bank runs? What can we learn from the paper? That would be very helpful for the reader, I guess. Looking at NBFI, I was to some extent a bit confused because I wasn't really sure what is it that we're actually, what is the shock and what are the NBFI we're actually investigating here. So the NBFI in this study, as I read it, they are banks, but then it's like they receive short-term funding, they receive long-term funding, they issue loans to retail customers, industry services, so have a wide loan portfolio and invest short and long-term. And I was asking myself the question, if they are operating like a bank and look like a bank, and obviously, why is it not a bank? What holds the regulator back in saying, okay, this is a bank and it falls under regular regulation? So maybe you can talk a bit about that. And then you look at the effect of NBFI on NBFI, because you talk on the one hand that mutual funds are start pulling out investments, which is called the shock. And then you say like mutual funds withdraw short-term funding, which is coming from the shock on the funding of NBFI. And I was always wondering, so is it within NBFI certain things happening? Or like I had difficulties when it comes to the shock, as you see also on the next slide. So what kind of NBFI do you exactly include in the study? That would be very helpful to understand. So you write in the analysis focus on a total of 332 investment and credit companies. But then investment company is a mutual fund, right? So there you want to be more exact, I think, or more explanations. As I said, like more explanations will be my main comment. So is it mutual funds, lending platforms, family offices, bank affiliated entities, or whatnot? So provide more details on this. The liquidity shock. So I'm listing here the sequence of events, if you will. It was not like in the morning somebody got up and said like, oh, we have a default. It was more a sequence of events which slowly unfolded. So the current description of the event is like, first you have a subsidiary of a large conglomerate which defaulted an intergroup deposit, and I never understood how you can default on a deposit. So you maybe want to describe more there. And then you have a short-term loan to the same financial institution was not repaid. Then the rating agency realized that and rated down the entire conglomerate. And then the stocks of the subsidiaries of this conglomerate company were going down. And then the market realized, oh, something is wrong maybe with NBFI. So the market started selling stocks. And then the mutual fund started to pull out investments from the market. A large mutual fund had to sell commercial paper of a housing finance company at a discount. So people were aware, okay, the NBFI sector might not be that stable anymore. And that further aggravated the panic. So stocks were going down and large NBFI stocks plummeted and spilled over to the commercial paper in the secondary market. And then we finally had some defaults. So you see, this is really a sequence of events. And then you say, aggregate CP outstanding and so commercial paper outstanding in the economy contracted, and mutual funds withdraw from CP holdings of NBFC, which declined during this period. And eventually the Reserve Bank of India got involved to restore confidence, and I get that, but maintain stability, not entirely sure about this one. So there was an intervention in the market. Now, yeah, so I think that the shock is absolutely plausible, but it's also quite complex. And then some of your results, I had the feeling this is the shock. I mean, you say the main results, like we investigate the impact on short-term funding of NBFC in the post-shock period. But this is like short-term funding was coming from NBFI, which are the mutual funds. And then banks which reduced lending to high exposure NBFC as a consequence of the shock. My feeling was more, we have the shock in the NBFI market, so therefore banks reduce. So this is still a shock. There is liquidity things going on. And then we delve into understanding reaction of the banking center to the liquidity shock. So it is like the shock and the results are kind of related. So therefore, are the results on funding not actually the shock itself? So it's not the shock driving the results, but the results are actually related to the shock because they are the shock. And I think it's reassuring that the identification seems to work, but then maybe reposition. And you have it in the title. You write this is the anatomy. It's not the causal consequences, but be more descriptive. And we always try to write it causal, but I think here it would be helpful to be a bit less causal and just say like, this is the sequence of events we are actually investigating. And then maybe you could look at NBFI lending, but I don't know if that's important enough then after you've identified all these things. So maybe, and another thing which came to my mind, can you maybe also speak about the relationship of banks and non-banks? Maybe they have joint investments or the banks are invested in the NBFI. How does it actually relate that those which are backed up by banks, for example, have an easier time and do not suffer those liquidity shocks? And then finally, I'd like to talk about the measurement. At certain parts, I was really confused. What do you actually measure? Like the unit of measurement. So do you investigate growth or changing growth? And when you go through the writing of the paper, you say like they face a decline, they cut down on lending, so reduce lending, which is clearly growth. But then on other parts, you have like, we see a slower growth and experience a decline in growth, and you have percentage points. So it's this change in growth. And this is quite important. If I have a 5% growth and minus 2%, so I still have positive 3% growth, but minus 2% change in growth. And it's important to understand. So I guess I understand what you use, because you also say you have variables year-on-year growth of stock. And then the period of analysis is from this time period. So it's the annual changes, and probably it's growth on growth. So it's a change in growth which you actually analyze. But if that is the case, then you look at the table 1, you see commercial paper growth is 18%, and total borrowing growth is 69.6%, which is huge. So then you look on the results, the commercial paper growth NBFC with high ex-ante exposure reduced by 14.5%. It's still positive, right? And then you look at total borrowing, the growth in total borrowings with high exposure declined by 58. It's also still positive. So they're actually still growing, just the growth has substantially slowed down. And the question is this a shock, or it's just like somebody putting on the brakes on a very, very aggressively growing market? So is it really a bad thing, if you will? And then, so how do the effects relate to each other? And then also you say banks lend more to better firms, so more healthy firms. But then you have like all these large numbers, and here you have 0.55. I was like, first, is that 55%? Is that, and then what do I do with the 0.55 in relation to like 70% and all the like? So what does that tell me in the interpretation? So here again, more details on the exact explanations and definitions would be required to better understand the paper. So, but to conclude, what I think the paper shows is the market does a job, and finally you see something which is allowed to fail, where I think it's really great. Yes, we get some market cleaning mechanism going on. What I think is important, you should carve out the contribution of the paper to literature. So describe more, explain more. You see, none of the points like is really a killer point. It's more like write, explain more. And I think it's a very interesting, important paper, and which helps us all to better understand NBFI and their transmission when they have in response to liquidity shock. And I recommend reading it to all of you. Thanks.
Thank you. Let's see if there are other questions, and then if you want to come up or other comments, questions.
I have one question. So, Sonalika, very interesting presentation. I was thinking whether you could tell us whether you are thinking about exploring more qualitative variables. And I'm thinking about two candidates that could be interesting. One is ownership. So the ownership dimension, whether you have maybe some of these funds being part of the same conglomerate, maybe indirectly related. That could be something interesting to explore. And the second point relates to portfolio similarity. So whether investors may be priced in the fact that they see that two of these institutions have a similar distribution in their portfolio, in their assets, or they're exposed to a certain sector that happens to be related to this other institution that failed. Some indirect relation like that may speak for some sort of contagion, but in that case driven by this fact that there is this more qualitative aspect that is shared across different institutions. Yeah.
Yeah, very interesting paper. Also, I think this is a very important first step in understanding how this works. I was just wondering, I saw that in the regressions, whenever you include the fixed effects, your R squared goes from like 0.01 to like 0.5. I think you might want to consider putting either more bank controls with the exposure, because the exposure might be correlated with some other non-bank controls and non-bank controls. And because you see this increase in describing the variation. And maybe one way to do this is actually to put a bank fixed effect, then of course it absorbs the exposure, but you could interact with, for example, like a post dummy and have it on the, but maybe you thought about why not including more controls and maybe.
Okay, so that's a handful.
I'll get what I have one more.
Yes.
So I wondered if you could say more about the stabilizing government interventions and how they worked, and it would be a different view from what Bjorn expressed, which was, that the market worked. What was undone by the government interventions, and what were they?
Okay, maybe I'll go in the reverse order because that's the hardest to address, and I'll. So Linda, I'm not sure if I understood your question correctly, but are you asking me what were the ways in which the regulator managed the situation?
Yes.
Okay, so we think that, of course, one of the things the regulatory body did for the non-banks is to not do much. Also because this was a shock that happened to the commercial paper market, which essentially constitutes around 25-30% of the entire market. So they did not see it as a run. They saw it like one conglomerate facing stress, and they did not do much to really intervene, and they allowed the capital reallocation to happen while being mindful that the spread doesn't, it doesn't move to as a contagion to other segments, and alternate sources of financing are also not so hard hit. So that was the one thing they did. The other thing they did is one way to ring fence the banking sector was by adding more macroprudential stringency in how the banks can lend to the non-banks. So they increase the risk weights to the non-banking sector so that the banks can do a selective sort of a lending process to the non-banks, and only then, therefore, probably they continue to lend only to the healthier non-banks as opposed to the unhealthy ones. So these are two things that we are able to identify, but we may also want to look at more. I'm not sure if that
So
completely answers
was that decision to lend more only to the healthier ones a product of the regulation, or?
Yes, that's what we think.
Okay.
So that's where the Reserve Bank of India came in and tried to make sure that even though this shock happened, you continue lending to the non-banks so that even the good ones don't go down under. And because in India, and this probably partly addresses some of Bjorn's questions as well, a lot of non-banks perform like banks, right? Also, I think one of the things I should have mentioned is that when I say non-banks, we are not including pension funds, insurance companies, we're not including those because these are not regulated by the Reserve Bank of India. There are other regulatory bodies like SEBI, IRDA, Insurance Regulatory Development Authority. They are looking at those non-banking entities, and they are not as sizable as these non-banking financial companies, which are regulated by the Reserve Bank of India. These non-banking financial companies do perform a lot like the banks because they are deposit-taking ones and they are not deposit-taking one, but then they are principally involved in the business of lending, right? So they do act like banks, but the differentiating factor is the regulatory arbitrage. That's the main difference, right? Which could be a good thing and a bad thing, right? So the reason we think it's a good thing is the mechanism that we showed in the paper, that the market was working when there was a shock. But off the record, this could be a risky proposition because there could be diversion of funds from the banks going into the non-banks and probably into not very credit-worthy borrowers. So that's a different sort of a paper. I have another paper on macroprudential, which probably you would have seen, I'm not sure, but that talks about how there is shifting from the banks to the non-banks as the banks become more stringent. As the bank regulations become more stringent. So yes, they do perform a lot like non-banks, but majorly it's regulatory arbitrage, which India has deliberately sort of enabled to have an alternate source of credit flow for the economy. But at the same time, we are mindful, Reserve Bank of India is mindful that there's financial stability that is preserved in the non-banks. So that's the way that we understand it. And we can, of course, debate about it more deeply. Your question, yes, we can certainly add more controls, and that is something we want to do. Probably also look at some IB regressions. So maybe that could address a lot of your questions.
Oh, no, I think the exposure is fine, right? So you have
Yeah.
this exposure to rollover risk, right?
Yeah.
This is what a lot of people did during the GFC. I think this is, if you were telling us that nobody saw this coming,
Mhm.
I think the shock is very good. But maybe just the exposure was correlated.
Your question. So you asked me about ownership and portfolio similarities. I think that's a great point. We did look at some of those, and I think a lot of it is also lack of data. Like, so we don't have enough data to see really how these are, like conglomerates are linked with one another. But we can definitely try to get more institutional information, because I think that could help the entire, setting of the paper and how we're impacted. So, yeah. About Bjorn's comments, let me see how many I could answer.
Well, maybe
Oh.
I think we're gonna have to
Okay,
move on to the next paper, so maybe after the session.
Sure.
Great, but thank you both.
thank you.
Thanks a lot for the organizers for putting this paper on the program. So this paper is called Non-Bank Lending During Crisis. It's joint work with Inaki, Aldasoro, and Sebastian, Doerr, both at the BIS. So the usual disclaimer applies. So we're motivated by the general fact that there is a global expansion of non-bank financial institutions. As Brion just alluded to, non-banks are not only active in markets such as the money market, but it also does a lot of lending. So it has potential implications, not only for financial stability, but also for the real economy. So from the perspective of the borrowers, having a non-bank as their lender additionally could potentially introduce a diversified funding mix for the borrowers, but it could potentially also include introduce possibly greater cyclicality. So it's not only studying non-banks is not only mattering for market liquidity, but also for lending to non-financial firms. So current literature mostly focusing on differences in terms of funding models. Non-banks might be attracting more wholesale deposits, and they're potentially going to be more cyclical in terms of their underlying liability structure. Especially work focused on US basically shows that non-banks display more cyclicality in their lending to non-financial companies, emphasizing the importance of funding models. But relatively less is known about, for instance, the global operations. And what this paper tries to do is try to uncover how do non-banks adjust their lending during, let's say, a crisis happening in the borrower's country, and what are the potential drivers, and especially beyond the usual notion of a funding mix or funding model differences. So if you want to take away one single figure or a bottom line from the paper, is basically this thought. So here we're showing the locked loan volume extended by non-banks versus banks around the window of the onset of a financial crisis in the borrower's country in a 4-year window around this event. And we're normalized the period -1 to 1 for both banks and non-banks. So we're basically plotting the relative differences here. So here, as you can see, that non-banks really curtail their lending actually by 50% more than banks. And we show in the paper that the results are robust, including a granular set of fixed effects. For instance, accounting for credit demand effects by including borrower time fixed effects. But we also show in the paper that there is real effect in the sense that non-bank connected firms saw higher decline in borrowing and investment. So we want to go one step further to explain the underlying differences between non-banks and banks. Obviously, one potential candidate is that there is potentially selection into different types of borrowers. So indeed, the borrower characteristics could account for half the gap between non-banks and banks. And the difference actually narrows from 50% to 25%, predominantly because non-banks tend to lend to riskier firms on average. What about the remaining gaps? So in addition to this funding model differences that the literature typically look at, we actually look at another potential factor that has been extensively documented in the banking literature, which is relationship lending. We attribute 2/3 of the remaining gap to differences in the value of the lending relationship across lender types. We account for intensity of lending relationship internal regression, and we find that the decline of non-bank lending versus bank actually narrows by around 2/3. And that leads to the conclusion that having an existing lending relationship with a non-bank is potentially going to be relatively less valuable to firms, especially during a crisis. From the policy standpoint, the point of the paper is that if we observe a transition from bank to non-bank lending, we're potentially also going to observe a transition from relationship-based lending to transaction-based lending. And that is potentially going to amplify some of the associated financial instabilities to the non-financial companies. So I'm mostly going to skip the literature, but I just want to mention that our contribution of this literature is trying to look at a global data set, and we try to stress the importance of relationship lending for non-banks and the relatively less in terms of importance for non-banks. So data. We basically look at syndicated lending, because syndicated lending is essentially a very important source of funding for large non-financial companies across the globe. And we use DealScan, which contains loan level information in the primary market. And we basically adopt very standard cleaning procedures following the literature. One of the important steps that we need to make in this paper is try to identify non-banks. So here the bottom line is that we divide banks and non-banks based on whether they take deposits. We start from DealScan's classification scheme, and it gives us whether a lender is considered to be a bank, an investment bank, insurance company, financial company, and so on. And we try to manually label some of the unclassified and misclassified lenders such that we get as much information as possible. And as an additional step, we try to connect with the company set data set to obtain some information on the borrower characteristics. So in our final sample, 32% of the lenders are considered non-bank in our sample, which predominantly includes investment banks and financial companies. Knowing that this is a primary market data set, so there is very little involvement in CLOs or mutual funds in this sample. Okay. It might be a good time to digress a little bit to tell you a little bit on the status facts related to non-bank lenders, which our BS review article contains more detail. But here I just want to say that non-bank syndicated lending has been expanding massively since 3 decades ago. And it actually represents a sizable share of the total in most of the countries and also most of the industries. In terms of concentrations, non-bank lending is really concentrated across countries and industry, and it is more volatile. In terms of the pricing, non-bank loans tend to carry a higher spread compared to bank-intermediated syndicated loans. Okay, going back to the paper, we want to connect our data with we want to basically identify crisis episodes. And we do that by merging our data with the Levin and Valencia Systemic Banking Crisis Database, which contains 82 banking crises from 1995 to 2018. And we want to also construct a crisis exposure measure, which is continuous and intuitively capturing the idea that the lender is relatively more exposed to a country in crisis when they have a relatively high existing stock of investment. So here, basically, this crisis exposure is basically weighting the banking crisis dummy with the amount of its total amount of outstanding loans granted by a specific lender to a specific country as a share of their total loan book. Okay, so on average, this crisis exposure variable is basically 6%. So 6% of the total portfolio is extended to crisis countries. So the final example runs from 1995 to 2018, and we aggregate them to the annual level. But today, I'm mostly going to talk about extensive margin results. By extensive margin, I mean that we account for not only the size of the lending, but we also account for formation and termination of lending relationships. Okay, so our empirical strategy to account for the differences between non-banks and banks essentially regresses the log of new credit extended by a specific lender to a borrower on the lagged crisis exposure variable, plus also the interaction term between crisis exposure and non-bank dummy. So obviously, without other terms, there is a classical endogeneity concern that, in particular, banks and non-banks may select themselves into different types of borrowers. So here we address this problem in particular by including borrower yield fixed effect to try to absorb some of the credit demand, some of the effect coming from credit demand. But we also want to sort of separate ourselves from existing literature talking about, for instance, funding model differences by including lender parent yield fixed effect in particular to account for some of the unobserved primary lender characteristics as well. So our coefficient of interest is beta 3, the coefficients associated with the interaction. So you can interpret this as the change in loan supply by non-banks relative to banks after accounting for all these credit demand effects and also some of the unobserved lender characteristics that I just touched upon. Okay. So now I'm going to take a very progressive approach by adding these fixed effects very progressively, step by step. Okay, so if we only look at a regression that regresses the log of new credit on crisis exposure, we can see that on average, lenders do significantly reduce lending after the crisis in borrower countries. And in terms of magnitude, 1 standard deviation increase in lender exposure to crisis is associated with 9.1% decline in new credit extended. If we look at the interaction term, the magnitude is quite large between non-banks and banks, as I just touched upon in introduction. So here the interaction term is statistically significant and negative, and in terms of magnitude, it's 22.5% for non-banks versus 8.3% for banks. Now we want to include, for instance, this lender parent yield fixed effect to account for potential differences in funding models and also other lender characteristics. And you can see that the coefficient estimate is relatively unchanged for the interaction term. So here, it seems that in global context at least, the differences in funding models and other lender characteristics do not really explain this lending gap. What really explain the lending gap here is once we include some sort of controls or some sort of fixed effects that account for these borrower selection effect and credit demand effect. And so here we're absorbing credit demand via borrower country sector size time fixed effect, which has been shown in literature to be an alternative way of introducing these credit demand controls. One of the advantages is that it doesn't really require you to restrict to multiple bank firm relationship observations. So here, as you can see, compared to column 3, the estimated coefficient shrinks by exactly 1/2. And if you want to be more stringent, by including borrower time fixed effect, restricting yourselves to multiple bank firm relationship observations, you can see that this coefficients remain largely unchanged, and the relative coefficients shrinks by around 50%. Okay. So now I hopefully convinced you that there is a sizable gap between non-banks and banks in terms of their lending behavior during the crisis. Now we want to take a step further to try to explain the differences. We want to take this perspective into relationship lending. So despite the fact that relationship lending has been studied extensively in the banking literature, we don't really see a lot of discussion on the value of lending relationships for non-banks. So we measure lending relationships based on the literature by introducing, for instance, duration measure or the strength measure. By the strength, we mean the number of loans extended over the past 5 years. Also, we want to also control for some potential other determinants of the lending gap. For instance, if a lender is specialized in a particular industry, they might possess superior information such that these information could support themselves into continuing lending to an industry during crisis. Also, if a lender is more diversified in terms of their portfolio, then one idiosyncratic crisis happening in a particular borrower country may not result in a substantial retrenchment of the lender. Okay, so now we're basically interested in a bunch of variables, but potentially we're mostly interested in the changes of the interaction coefficient in the second row compared to the original coefficient after we introduced credit demand effect, which is minus 0.314. If you focus your attention to column 3 here, where we include most of the relationship measures that we constructed, you can see that the coefficients associated with crisis exposure times non-bank shrinks by around 2/3. Okay, and also we show that accounting for some other potential explanations, such as industry lending share or lender diversification, doesn't really change the entire picture. So from this table, our conclusion is that the value of lending relationships with non-banks doesn't seem to be as strong compared to banks. Okay, so we're mostly talking about quantity at this point, but what about prices? So lending relationships may also matter for prices. So we also run this regression on the spread charged by a particular loan on the crisis domain and also relationship measure and their interactions, accounting for also a number of their effects. Okay, as you can see in column 1 here, having a crisis does have a significant positive impact on the pricing of loans, having basically the pricing of loans being more expensive. But if you look at, for instance, the crisis times relation interaction term, having a good relationship with a bank is actually going to help you dampen some of the impact on the prices during crisis. But if you look at triple interaction term for non-banks, non-banks doesn't seem to protect their borrowers during crisis. Okay. I also want to mention that if you look at this non-bank time relation interaction term, you can see that this is significantly negative, which means that during normal times, non-banks do not really charge a higher spread, but they don't protect their borrowers during crisis time either. Okay, so I think I do have some time to go through a little bit of extensions, but basically here we have 2 extensions talking about selection effects. One is that risky borrowers do suffer more during crisis. So here, if you augment our baseline regressions with the triple interaction term, capturing whether a borrower could be considered high risk or low risk as measured by above median spread charged across country, industry, or from countryside data above median leverage or not. So as you can see that most of the retrenchment that happens to non-bank during crisis comes from high-risk borrowers. What about real effects? So here we're regressing basically the changes in loan volume and investment on firms that are basically connected to non-banks and an interaction term associated with the crisis system. As you can see here, for non-bank connected firms, it seems to exhibit a stronger decline in loan volumes and investment after the crisis. Finally, I want to mention that our results are robust to a bunch of different sample cuts, and also some of the transformations with dependent variables as well. And now I think I can conclude. So I hopefully show you some convincing evidence that non-banks contract their syndicated lending by more than banks during financial crisis in borrower countries. And a lot has to do with borrower selection. Non-banks tend to extend loans to riskier borrowers. The borrower characteristics tend to account for half of the observed gaps. But also, we also see some evidence that suggests that the value of lending relationships seems to be relatively low for non-banks compared to banks. They seem to more engage in some sort of transactional lending compared to relationship lending. From a policy perspective, as I said earlier, the rising footprint of non-banks could potentially lead to a shift away from relationship-based lending to transaction-based lending, and that is potentially going to be a concern for financial stability. So in addition to monitoring non-banks in the money market, we probably also want to monitor the activities of non-banks in the syndicated loan market that is closer to the real economy. I'm going to stop here. Thank you so much for your attention.
I am Ragnar. Ragnar, if you're watching, I hope you do justice to your remarks. He apologizes that he couldn't be here. He came down with the flu just before he was. Oh, is it not on?
I think
It's on. He apologizes that he can't be here. He became sick the day he was supposed to board his flight.
yeah, listen. Yeah.
So these are 100% the remarks of Ragnar from the Norges Bank. Okay, so what is this paper about? I'm gonna really try to do this smoothly, but forgive me. So this is the key figure that the paper is trying to describe. There's parallel trends before a crisis, and then once the crisis hits, there's an economically significant gap that opens up where 15%, which is 15% relative to the normal variation in credit. So this is large. The majority of this gap, as we just heard, disappears when you control for these relationship proxies. So that's a really important finding. And so the big contribution of this paper is to highlight the importance of lending relationships and the differences in relationship lending between banks and non-banks. And this, of course, is important for all of these financial stability questions. And, in general, about when financial conditions change and the composition of your credit provision changes, what happens domestically. So it's a very well written and thought-provoking paper from Ragnar. Okay, so the comments, there are three main comments. The first is on unpacking why relationship lending explains the lending gap. And here, the comment is going to be on understanding the value of relationship lending versus gaps in the extent of relationship lending by different types of counterparty. In terms of the second comment is isolating the effect of relationships. And there are some comments on relationship proxies versus strategic considerations. And then the third set of comments is why do non-banks respond to crisis? And what's interesting here is that the paper suggests that it is not about liquidity in this particular case, which is the syndicated lending. And the reasons potentially matter for normative aspects because there's one case, it's a tightening of constraints, and the others, there's an optimization problem, an optimal decision. So let's get to unpacking the estimated effect. And so this is the general form of an estimated model for the bank and non-bank provision of credit. And if you measure this, then, which is what you start out with, it's subject to omitted variables bias. And what you really should have are, what you really should introduce is not just the exposures to the locations that are distressed, but also information about the relationships shares, because there is your variable of interest is the gap between beta 1 and beta 2, because this matters for how much you're going to adjust credit. So this formula highlights that the drop in the lending gap, once you control for relationship status, can come from one of two things. First, it could be because there's a large beta 2, which is that relationships are valuable during a crisis, or it could be that there's a large in absolute value covariance between being a non-bank and the amount of relationship lending. So are there large gaps in how much of this takes place across types of institutions? So it'd be really useful to unpack that issue more to know the relative contributions of the beta 2 piece versus the kind of behavioral piece. And so the existing literature seems to have established 2, but there's been much less of a focus on that second point. The second comment, again, on isolating the role of relationships, and just to editorialize here, I think that's a really, really cool direction of this paper. and very much worth understanding. And as was said, we know about this in banks. We know much less about this in non-banks. So banks and non-banks are usually careful about which markets to strategically prioritize. So bank strategies potentially are more sticky compared to non-banks. They're investing in a physical presence associated with fixed costs. A potential confounder here is that variation in market share targets across countries C. So a higher market share target implies higher crisis exposure and potentially higher average relationship proxies and lower willingness to cut back on credit during a crisis. So it might be interesting to do what Banerjee et al. Have done and maybe isolate some of that variation in relationship to mergers to see what happens when some of the structural changes have taken place across bank or non-bank institutions. And a merger would affect the relationship as branches are closed and existing managers, for example, are potentially transferred. The last main comment is asking why do non-banks potentially respond more to a crisis? So, we saw that big gap. The authors push the point that more non-banks can actually exacerbate shocks. And separate from these remarks, we also know that there is a lot less access of non-banks to some liquidity facilities. So it's not a liquidity story here, it's about relationships. If you want to understand the normative implications, it would be useful to really talk more about why the non-banks respond to crises. If it's not about funding, what else could happen? And so the key question is for the non-banks, is reducing credit a constrained or an unconstrained decision? So can you really shed light on that? That would be really interesting to know. So in sum, it's a well-written and thought-provoking paper. It nicely elaborates on the role of relationship lending and explaining why credit supply of non-banks are more sensitive to crisis episodes compared to banks. But there are, a couple of pieces in addition of unpacking this that would be really useful to see. So Ragnar, thank you. We could answer Ragnar. And so take questions.
Very related to the last comment, there's a paper by Doerr, starting at that twice last year in the which was on spillover effects in corporate finance. And your paper reminded me a lot that you should have a look into that, because it's usually not just, we always look at different relative effects, but it's where something is going away, so less lending, somebody takes over. And it would be nice to see like how much this is driven by the banking part, that they take over from the, so the question is like, what's the channel? So where's it coming from? It's not liquidity. So maybe the banks are just taking over and maybe even increasing, and this is what drives then the negative effect you observe. Yeah, would be interesting to look at.
So I'm a little stuck on this. This is not about funding costs. So it's not that non-banks exist in this vacuum from banks and banking crisis, but there's in the US, if I'm not mistaken, something like $2 trillion of credit extended from banks to non-banks. And so the banking crisis hit, the banks might actually retrench from lending to non-banks, which makes it much harder for them to participate in the market. So it really depends on which of the non-banks are in these markets. And that could be one of the reasons why it's actually even more drastic for non-banks, simply because their own funding structure is affected by what comes from banks.
Just want to understand the mechanism. I understand the banks cut lending in crisis because they face a regulatory constraint becoming more binding, they have to cut back. But what about the non-banks? Why do they respond more than banks? What kind of constraints do they face? It's related to the discussion. Is it a constraint or unconstrained optimization outcome?
just trying to understand the data a little bit because these are syndicated loans, right? But some of the lenders, especially banks, can be your own country banks too.
Yeah.
And actually, I was looking at the data for India that I have, and I see a lot of like Indian banks lending to Indian companies, but I don't see a lot of Indian non-banks lending to Indian companies. So I'm wondering if this could also be accounted by, non-banks being mostly foreign lenders versus banks also being domestic banks in the syndicate, right?
Yeah.
Very brief, just 2 comments. Thank you for the presentation. Renee. So I was expecting 2 things to happen in your presentation, and they didn't happen. So the first one was to look at different types of crises. I was expecting you to say something about what happens when we have a banking crisis itself, like or triggered on the core of a banking system versus something that happens at the periphery of banks, maybe not touching them. That maybe could be something to explore. And the second part touches on something that Linda mentioned, or Ragnar, we don't know. And it's maybe digging deeper into the liability side of the balance sheet, where we see strong differences between the banks and the non-banks. And I'm thinking here about issues like deposit insurance, the fact that many of the borrowers are actually also depositors of the bank, and that could be a trigger for being willing to protect that relationship. But and the access to the central bank discounting to certain different prices, right? So all these 3 things matter and are a key difference between a bank and a non-bank. I don't know if you have data about the bank's balance sheets or something that could maybe proxy for the deposit reliance, something like this that you could maybe shed light on whether this liability side stories play a role in the story. Thank you.
You have 2 minutes.
Sure. Yeah. So I just want to start off by thanking Linda for taking care of the Ragnar's presentation about Ragnar. So in terms of considering funding models. So unfortunately, data on non-bank balance sheet is substantially less than data on bank balance sheet. So we started off trying to think of this paper by trying to think of this paper as depicting differences in terms of funding models. But because of data constraints, we decided to think about this problem from a different angle, which is relationship lending, right? So one of the concerns is about bank, non-bank interactions and bank having a lot of funding to non-banks. One of the alleviating factors in our study is that we look at borrowers' crisis. We're not looking at what happens when the lender's country experiences a banking crisis. So it's not necessary that following a borrower's country's crisis, the underlying bank funding to non-banks because it experiences a substantial change. But this is something that is very useful to check as well. In terms of the mechanism of why non-banks could be more flighty and banks could be relatively less flighty, honest answer is I don't know at this point. So it is very valuable, as Ragnar just said, and as the participants just asked, to understand whether non-bank lending is a constrained versus unconstrained decision. This is something that I don't have an answer to at this point. And finally, on the data, essentially a lot of the syndicated lending extended to, in particular, non-financial companies, has to do with foreign lenders participating in one's large syndicate. And a lot of the non-banks in our sample are basically large investment banks, such as Morgan Stanley and Goldman Sachs. It doesn't really take a lot of deposits, but they're still considered in our paper and also on other type of paper considering non-bank lending as non-banks. So, but I just want to say that our results are pretty robust if we consider different types of non-banks, excluding investment banks, or just considering an alternative cut of the investment bank by classifying them into those banks and those non-banks that were stable versus non-stable lending. So I think that partly addresses the problem. But thanks a lot for all the comments and questions, and thanks. Yeah.
Okay, the last paper of the session is on the effects of bank capital requirements on lending by banks and non-bank financial institutions. Now we hear about constraints.
Yeah. Good afternoon, everyone. Thanks a lot for joining the presentation, and thanks to the organizers for including the paper. It's a joint work with Stephen Ongena from the University of Zurich, as well as Bednarek, who is in the audience, and Natalja from Westernhagen, both from the Deutsche Bundesbank, therefore usual disclaimer applies. The research question that we address in this paper is whether increased bank capital requirements could lead to growing real lending of non-bank financial institutions and other institutions in turn financed by banks. We focus on the German financial system and we apply differences in methodology to the German credit register data. And we find that indeed, after an increase in bank capital requirements, NBFIs relatively increase their lending to the real sector. We think that it's an important question for two reasons. First, bank capital requirements have significantly increased since the global financial crisis. However, their impact on the stability of the overall financial system remains unclear. And in particular, there is research showing that higher bank capital requirements might be even counterproductive, in particular in the presence of less regulated NBFIs. And secondly, growing importance of NBFIs in credit markets have attracted a lot of attention, as we have already seen today. These institutions may pose bank-like financial stability risks, and that in particular could be attributed to the differences in regulatory standards. And therefore, it's important to understand what is the role of bank capital regulation in these developments, and that's where we try to compete. Empirical analysis of bank capital requirements is challenging, in particular due to the lack of exogenous variation. And we try to overcome this challenge by exploring 2011 European Banking Authority capital exercise. This exercise was announced in October 2011, and it required participating banks to increase their core tier 1 capital ratio to reach the level of 9% by the end of June 2012. It was a sudden and sizable increase in bank capital requirements, and there are many papers that argue that this capital exercise could be considered as a quasi-natural experiment. And the main arguments are the following. So first, capital requirement increase was economically significant. It came just a few months after the 2011 EU-wide stress test, and it had to be satisfied in remarkably short time period. Another important feature of this capital exercise is that it was implemented in a way that it affected at least 50% of the national banking sectors in descending order of their total assets. And this implies that 13 German banks participated in the exercise with the estimated aggregated shortfall of 13 billion euro. And such implementation of the exercise creates an almost ideal setting for differences analysis, since only certain German banks were affected, but it did not have a direct impact on NBFIs. As I already mentioned, there are several papers that analyze the impact of the capital exercise. However, to the best of our knowledge, they are mostly focusing on the impact on banking sector. So, for example, how banks adjust their balance sheet in order to meet the new requirement, whether banks ask for more collateral, or if there are any cross-border events. And we would like to contribute to this stream of literature by going beyond the banking sector and analyzing what is the impact on non-bank institutions. The research on NBFIs is rapidly growing, but is still rather limited, and in particular due to the lack of data, since those institutions are less regulated. However, the result that we've seen so far indeed point in the direction that tightening of bank regulations leads to the reallocation of credit to NBFIs. And the paper, which is probably most related to our one, is by Iranian authors who demonstrate reallocation of credit from undercapitalized banks to non-banks through trading in the secondary loan market following the implementation of Basel III. And we would like to contribute to this theme of literature, and in particular this paper, in the following way. So first, we explored a quasi-exogenous increase in bank capital requirements. We employ granular credit register data, which contains total exposures and not only syndicated loans. And another important feature is that the reporting threshold is rather low. And moreover, we are focusing on NBFI types which are present in the German credit market. And as you heard today, the NBFIs all over the globe are pretty different. Okay, so talking about what do we mean by NBFIs in this sector, in this paper, sorry. So according to the Financial Stability Board, a broad measure of NBFIs comprises of all financial institutions that are not central banks, banks, or public financial institutions. However, in this paper, we focus on the NBFIs that provide credit to the real sector firms and are either subject to the credit register reporting by themselves or through their head institutions. And in this sense, we are focusing on the narrow measure of NBFIs, providing economic bank-like function of credit intermediation and lending. So in the credit register, we see the following types of NBFI lenders. The insurance companies, financial enterprises, factoring companies, leasing companies, non-monetary financial institutions, capital investment companies, equity holding companies, and banks. So we focus on the first 5 categories since they're the largest and they cover almost the full exposure. And the remaining ones, they are pretty small. And in the case of banks, for example, even the business model is very different since these institutions are not even always profit-oriented. So we drop them from the analysis.
So could you briefly clarify who has to report or who doesn't report? Because that really matters. Like what's the reporting requirement to be included in the credit register if you're non-bank?
So all those types of institutes, they have to report.
They have to.
Yes, yes. So to better understand the market that we are considering, we provide some descriptive statistics, and in the table you see average values over the pre-treatment period. So we see that we have 13 EBA banks and a bit more than 1,500 non-EBA banks, and they cover about 38 and 52% of the total exposure respectively. We also have about 500 NBFIs with the total exposure of 64 billion euro, which corresponds to about 9.6% of the total. We see that the median NBFI is smaller than the non-EBA bank, but at the same time, the exposure of a median NBFI to a single borrower is significantly larger than the one for a median non-EBA bank. And this indicates that NBFIs might have a less diversified borrower base. NBFIs per se, they are also rather heterogeneous in terms of their characteristics, business models, and regulatory requirements. And the largest group of NBFIs in our sample are insurance companies, which mostly consist of property and casualty insurers as well as life insurers. And the example of credit exposure which is present in German insurance companies is a so-called promissory note loan. It's a type of debt instrument which is often arranged by a bank, and it contains a promise of the issuer to pay the value of the loan to the holder of the note. But it's usually very easier to obtain than a usual bank credit. So at the time of capital exercise, insurance companies were subject to Solvency II capital requirement, which was not risk sensitive. The second largest group in our sample are financial service institutions. And those are the entities that are not banks, but they carry out at least one of the bank-like business activities. And in our sample, they are mostly factoring and finance lease companies. And both types of the institutions didn't face any capital requirements. So a few words about data methodology. As I already mentioned, we use German credit register, which contains outstanding exposures at the end of each quarter, which exceed 1.5 million euro. In our baseline analysis, we consider lending to German real sector firms, and then we extended also to the lending to NBFIs. We focus on the time period between the first quarter of 2010 till the first quarter of 2013, which corresponds to 4 quarters before the treatment and 9 quarters after the treatment. And here, unfortunately, we are rather limited in how far we can go back in our pre-treatment period. First, because financial enterprises didn't report to the credit register before 2010. And second, we observed a crisis in the German leasing industry, which was first driven by the global financial crisis, but also by the corporate tax reform, which reduced the deductibility of leasing payments. Therefore, we have to start rather late. In terms of methodology, we use collapse difference and differences approach, with the main dependent variable being a change in the average quarterly growth rate of the total exposure from lender L to borrower B. And our main explanatory variables are dummy variables, which indicate a type of lender. So it can be NBFI, non-EBA banks, and as the reference group, we use EBA banks. In order to further disentangle the impact of credit supply shock, we try to control for demand in the spirit of Vladimir Young, and we build borrower groups depending on their industry location and size. And
just clarify, is it growth, delta growth, the change in pre and post treatment?
Yes, so we compute the average growth rate in the pre-period, in the post-period, and we find the difference. Okay. Yes, yes, and so just to finish with the demand, we include borrower group fixed effects to control the time. So now our main results. So first we consider NBFIs as a single group, and we find that indeed after the capital exercise, NBFIs slow down their lending to the real economy less than EBA banks, and by about 2.2 percentage points a quarter. And we find a similar effect also for non-EBA banks with about 1.6 percentage points a quarter. This estimate seems to be also economically significant when we compare them to the average growth rates in the free period, which were about minus 1.3% for NBFIs, minus 0.2% for non-EBA banks, and plus 0.5% for EBA banks. Next, we split NBFIs into different categories, and we find that the effect is mostly driven by insurance companies, financial enterprises, and factoring companies. And the only negative coefficient which we obtain is for leasing companies, and we look at it that it still could be outcome of the slow recovery from the crisis that they face. As the next exercise, we look at the change in the likelihood of credit being granted, and the dependent variable is a change in the quarter-to-quarter probability of entering or exiting lending relationship. And we find that after the exercise, both NBFIs and non-EBA banks, they increase their probability to enter a new relationship, and at the same time, they decrease the probability to exit the existing ones, relative again to the EBA banks. What is interesting is that the prevalence of intensive and expensive margin results differ by the type of NBFIs. So, for example, for insurance firms, you find the effect both on the intensive and extensive margin, while, for example, for financial enterprises, it's only on the intensive margin. And this is rather in line also with the descriptive statistics that we've seen for this category, because the median financial enterprise actually serves only one borrower. So it's not surprising not to see the effect on the extensive margin. To better understand the underlying channel of such credit reallocation, we try to analyze the impact of different borrower characteristics. And first, we split our borrowers in three segments depending on their riskiness. So the low and high risk segments include 25% of the borrower groups with the lowest and highest probabilities of default, and the remaining ones are classified as risk. And here we find that NBFIs start to lend relatively more to the moderate risk and high risk firms, and in the low risk segment we don't find the effect. And we think that this could be in particular attributed to the differences in regulatory standards, because at that time point banks already faced Basel II requirements which were risk sensitive, while on NBFIs they either didn't face any capital requirement or they did not depend on the credit quality of their borrowers. And this result is also in line with the theoretical prediction by Martinez, Mier, and Ripulo, who showed that tightening of risk-sensitive capital requirements indeed leads to the reallocation of riskier borrowers. Next, we look at the concentration of lending in different borrower segments. So for each borrower group, we compute the Findel index indicating pre-treatment concentration of lending, and we find that NBFIs increase lending significantly more in the most competitive segments. And these results indicate that NBFIs rather act as competitors to the banks, and they use this opportunity to expand their lending in the most competitive segments. Then we look at the change in the availability of total credit by conducting analysis at the firm level. So here the dependent variable is the growth rate of total lending to a particular real sector firm. And we define EBA dependent firms as firms with the highest share of credit from EBA banks in their total borrowing in the pre-treatment period. And we find that despite the growing lending activity of NBFIs, EBA firms anyway face a drop in the total credit. And then we also analyze if existence of the previous relationship with NBFI. So if a firm was already borrowing from a non-bank financial institution in the pre-treatment, if it makes it easier to shift to the credit from non-bank in the post-treatment period. However, we do not find evidence of such channel. And as the last exercise, we try to analyze a link between banks and NBFIs. So we test if banks could use NBFIs as intermediaries in order to transfer credit to the real sector firms. And why would banks do so? So we look at it more from the regulatory arbitrage perspective. So in Basel II, the risk weights on the exposure to non-bank financial institutions was not higher than to the real sector firms in the same credit risk bucket. And moreover, in our sample, NBFI borrowers tend to have lower probabilities of default than the real sector firms. So what we do here, we test if banks increase their lending to certain categories of NBFIs, and if these NBFIs in turn increase their lending more to the real sector firms. And we identify several potential channels. So for example, we look at NBFIs that are affiliated with the EBA banking groups. We look at intermediary NBFIs, meaning the NBFIs that were already both borrowing and lending to the real sector firms in the pre-treatment period. And we look at NBFIs which have a similar borrower base as the treated banks. However, we don't find significant evidence to support any of those channels, which indicates that banks do not systematically engage in such type of regulatory arbitrage. And we think that this could be associated with the fact that first, this increase in bank capital requirements have to be satisfied in a relatively short time period. And moreover, when the exercise was announced, it was announced as an extraordinary and temporary measure. So we think that banks just in this particular case did not have enough incentives to engage in such a complicated scheme. So with this, let me conclude. So we find that increased bank capital requirements lead to a growing lending activity of NBFIs relative to the affected banks, and this effect is heterogeneous across NBFI categories, and it is not sufficient to fully compensate the drop in lending to the EBA-dependent firms. We also try to provide an evidence that NBFIs rather act as competitors to banks, so they expand their lending in riskier and less competitive segments, and we do not find the evidence for banks using NBFIs to lend to the real sector firms, which once again highlights that they are likely to act as competitors. And so with this, I conclude. Thanks a lot for your attention. I'm looking forward to the comments. That's the mic.
Thank you. Good afternoon from me as well. Thank you for the opportunity to discuss this paper and be at this conference. I will very briefly summarize the paper. Olga did an excellent job, so I will just devote a few seconds to that. Then I have three major comments, and if there is a time, I have also some minor comments and questions. So, regarding the objective of the paper, the authors are trying to estimate the impact of high capital requirements on German banks, but also non-banks. And for this purpose, they are using this exogenous event, the 2011 capital exercise of the European Banking Authority. They are using credit register data of Germany around this event. In the treatment group, they are having 13 banks that are affected by the increase in capital requirements. And in the control group, they are having non-banks and also banks, German banks that are not affected. They use the dip in this regression. Regarding the summary of the results, they show that after this capital exercise, after the increase in capital requirements, the non-bank financial institutions increase their exposure to real sector firms faster than the affected banks, than these 13 banks. They show that this effect is driven mainly by insurance companies, financial enterprises, and factoring companies. It's also driven by lending to more riskier segments, and they're measuring that by probability of default at the event at the industrial level, industrial location size level. And then also it's driven by lending to more competitive segments, but this effect is rather less significant or weakly significant. They also show, and I'm not sure whether it was discussed in the presentation, that this faster growth of lending by non-banks is not sufficient to fully compensate for the drop in lending by the affected banks. As Olga discussed at the end, they were trying but did not find any evidence for the regulatory arbitrage, meaning that the affected banks are not using non-banks to transfer the credit to the real sector firms, and they are performing a number of different tests. And last but not least, and I think this is under-discussed in the paper, all these effects they're identifying also for these banks, it's German banks, that are not affected by the increase in capital requirements. And in some cases, even more robustly. You already saw this table. My first comment, my major comment is about basically the economic significance of the result, about the aggregate impact, about the impact on systemic risk in the German financial system. Because as I am now reading the result of the paper is that the drop in the lending by the affected banks is compensated by the other German banks, not by the non-banks. At least in the term of the volume, because if you look at the table, majority of the exporters, majority of the lending in the German banking system is done by the banks. 50% by the non-affected banks, and only about 10% by the non-banks, and most significantly, 5% by insurance companies. If we look at the insurance companies, take the story about the non-banks lending more after this capital exercise, the real sector. As I see insurers, they are value investors with long-term horizon, with very stable funding. So these are the institutions that can take on more risk if there is the opportunity. So overall, as I read it now, the paper, there are limited real macro level implications and implications for systemic risk. What I would maybe suggest is to provide a simple back of the envelope calculations. You can use your current regression coefficients and some aggregated growth rates across sectors or volumes, just to provide some aggregated effects of your results, and maybe discuss more the role of the German not affected banks. The second major comment is about the size of the firms you are analyzing in your paper, and also the location of the lending. Because again, if I'm going back to the table, you saw the non-bank financial institutions in Germany at the time, they are relatively small, they are smaller than banks, and they may struggle to lend or to meet credit demands of larger firms. After there is this increase in capital requirements, these large German banks are not able or are dropping the lending to the real sector. Non-bank financial institutions are not those who are stepping in and lending to these larger real sector firms. Therefore, by default, I would expect that this lending will be to riskier, more competitive segment, because as I understand it, these segments are usually populated by smaller firms. My suggestion is to try to control for the firm size to really see whether the firm size is not something that is explaining your results. It's very easily done by introducing a triple interaction term with the firm size in your regression just to confirm or not confirm my hypothesis. And maybe provide, and I was missing that, some characteristics of the firms or the segment that you are analyzing that borrow from these different financial institutions, just to see whether the borrowers differ in their size pre and post the treatment. The second comment on the slide is about the domestic and cross-border lending, because again, I think that especially at the euro area, the single monetary union, the larger firms may have access to cross-border lending because they can lend in euro in other countries, unlike smaller firms. Okay, do you see these effects? Do you have the data on the cross-border lending? Can you analyze this? Can you, for example, control for this? You are saying no. Okay, but my suggestion would be to, if you have the data or at least some indication, maybe to introduce the triple interaction in your regression. It would be very easy to test for it, but if you do not have it, okay. Maybe the second bullet point in my suggestions, because if I understand it correctly now, when you are doing the test about the regulatory arbitrage, you are using this affiliation to the same banking group based on these 13 affected German banks. But maybe there is a potential for internal capital market with all these affected 71 banks, because the capital exercise concerned 71 banks in euro area. Only 13 of them were German. And what I would also suggest, I know that your paper is on non-banks, but I think that you identify quite robustly the effect on these not affected banks. And you can look at the same exercises which you did for this regulatory arbitrage, just extended for this not affected banks. And you can find that there could be some links, some shifting of the funds after the event, maybe. My third major comment is about the assumption of the methodology you are using, how the difference is different, which we all know very well. And maybe I just overlooked some of the discussion or explanation in the paper, but I was missing two crucial pieces of the information. The first one, I was not, I'm not sure, I was not convinced that the parallel trend assumption is satisfied in your paper, because I didn't see any chart. Maybe some argumentation which I actually didn't buy when I was reading that. I think in this case, it's especially important because we know that the non-bank finance segment is rapidly growing in Europe. And the results you are identifying, because you are using the collapse div, so you are looking at the difference between the growth rates of two segments. What you can be capturing is just the result could be driven by the drop in lending of these affected banks, not by an increase in lending of non-banks, if the parallel trend assumption doesn't hold, because there will be these accelerating trends of non-banks in their growth. The second comment is about the composition of the treated and control group. Again, I hope I didn't overlook it in your paper, but I would be interested how the composition changed of the institutions, financial institutions, but also the firms, and whether this can affect your result, because if the panel is balanced, then it's okay. If it's unbalanced, some of the results can be driven by changing composition of real sector firms, but also by the changing composition of non-banks or German non-affected banks. And last slide is just two minor comments or questions. The first one, again, is just a clarification in your paper, which I was missing. How detailed is your industry classification? Why is it important? Because you are using that for your identification of fixed effects, but you are also using that to identify the riskier segments and more competitive segments. So it would be interesting to see what type of firms you are pulling together. And the second question or point, as you talked during the presentation, the capital exercise was announced as temporary measure. So I was asking during reading the paper, whether the banks just do not decide temporarily rebalance their portfolios towards less risky exposures to increase their implicit risk weight, maybe investing more in sovereign bonds, households, exposures, lending not households, rather than a risky corporate sector. Why is this important? Because if this is true, I don't think this had a real macro level effect, because there is just a short-term rebalancing of the portfolios, not the long-term implication for the economy as a whole, let's say in terms of lending to the economy. My suggestion would be maybe to provide some similar statistics on the risk weights, risk-weighted exposures, capital to asset ratio, pre and post treatment. This is all. I think it's a very nice paper. It's highly topical. It's very important to study these interactions, this look into the regulatory arbitrage on the relationship between banks and non-banks. Your policy implications were mostly about the systemic risk and financial stability, and I was not convinced by the paper that the results we presented are significant from this perspective. So maybe try to convince the reader a little bit more. I don't think you need to incorporate all my suggestions. Maybe just try to convince the reader that you fulfill the assumptions of the methodology. I think this is important, and maybe provide a little bit more detail on the data. Thanks a lot.
Right, so we'll start.
Thanks a lot. I mean, for me, it's not really my literature, but definitely as a discussion saying and I share with the worry that you probably have to start for different trend existing. You started out in a presentation saying this is a kind of quasi-optimal experiment, but the banks, the underlying distress that were not casually drawn on the sample, not they were dead for a reason. So you really wonder when they were different, even important. What can you do about that? One thing was say, these apply to several countries, not just the Germany. So you may want to check what happened also elsewhere. Be convinced that the same mechanism is also in other countries existing. Try a placebo. Change your group of banks and see if your results stay the same. That you be worried whether something else is captured by your DFD.
I had almost the same question. Thank you for it's basically you want to make sure the treatment and control group are comparable for the shock. And the other thing I think you can explore a little bit is the capital requirement has the numerator and the denominator as the CAR as a ratio. So it's not just the level of leverage is restricted, but also the composition riskiness of the assets, like risk weights are important. The banks still have the ability to adjust to the risk weights, right, to different lenders, to different borrowers. So that might change the composition of borrowers rather than the quantity of the leverage. And the other thing is, I guess, you could, you could think a little bit more about this control and treatment group within the banking sector than the non-bank. This is Discussant's, point, right? The other non-traded banks are much more important than the non-bank financial institutions in terms of lending, I guess.
Yeah.
Yeah.
Wait, let's.
Great, Olga. I have a question about the type of products that the banks and non-banks offer. So for identification to hold, the firms would have to be indifferent between going to the banks and non-banks. But I think that some of these non-banks offer very specific products like leasing, factoring, whatever. Can you control for some kind of product fixed effects or?
Yeah, I also had a question of taking this to the macro. I think it's very in line with the discussion because there's a literature of banking contagion. And yesterday, Leslie Shane presented a super nice paper theory and the BIS evidence that says if you have a regulatory shock, then banks from outside will make up for a large chunk. So it could be very insightful if you say, okay, this was the shock, this is what the affected banks did not lend, so who stepped in? It's probably mostly the non-regulated banks, but also NBFIs and probably also foreign banks. And the other question I had, the same as the end, because you said that 52% are insurance firms and they give promissory notes, which I mean in German this is a Schuldschein. I don't even know how to. I mean, it's not really. Are you convinced that this is a substitute for a loan, and can we put them in the same bucket?
Yeah, I'm also very interested in this observation that insurance company to take a lot of the loan exposure. But my point is probably just for another paper, but it will be interesting to check whether there's actually a crowding out effect, because insurance company has a very large fixed income portfolio. So if you are taking on some of the loan exposure, I was just wondering if they have to sort of unload some of their corporate bond exposures as well. So if capital requirements from the banks that actually has some spillover effect in terms of crowding out some of the lending from some other markets, but that's potentially for another paper.
Try to cover the same question.
I tried to answer, so I think that thanks a lot for all the comments, all well taken. I think that the common theme seems to be why do we focus on NBFIs instead of non-EBA banks? And so here the idea was, so as I showed on one of the slides, there are quite a lot of papers that explored the shock to exactly compare EBA banks to non-EBA banks. And so our idea was like, okay, let's try to look maybe on a smaller category, but on a different one, right? And of course, like it's a way smaller category, it doesn't have maybe that much macro applications. And it's very, I mean, regardless of how much I would try to match them, I wouldn't be able to match German NBFIs with the EBA banks, right? So they're very different institutions. So in terms of the parallel trends, we tried to, I had a chart somewhere, so we don't argue that they are the same institutions, but we try to at least ensure that the growth rates do it a bit more or less parallel in the pre-treatment. And here, as I explained, we are a little bit limited in how long our pre-treatment is, and then we show the jump afterwards. And so our idea was to show that even in Germany, even when the institutions are so different, and the capital increases, they were not that high, we already observed such substitution effects. So this, we wanted to argue that then if you go into the more developed non-bank institutions, or even what we observe now already in Europe, that it's not 10%, it's 25% now, that those effects would be even more pronounced. That's why we wanted to study them in the lab setting that we had. So that was kind of the overall idea why NBFIs and not non-EBA banks. Yeah, and another comment regarding systemic risk. So another perspective to this was that, okay, they are small, so probably now they don't play such a role, but another thing which we observed is that it's far from, they're the institutions for whom lending is far from being their core business. And what we see, right, is they take on risky borrowers. So here the question would be, are they capable to deal with this risk? Are they capable to correctly assess it? And like, okay, now they're small, probably it wouldn't be that noticeable, but if this continues, would it be systemically stable or not?
But then I'm going back to the argument that this was temporary, and you mentioned that, because it would apply to what you said, this would be a long-term trend, not one of like increasing lending after one event short-term.
But in a way, it is long-term, right? So we constantly tighten bank capital requirements. So that was the idea of considering this precise exercise, which okay was temporary. Then we can question the external validity, right? But the idea was to indeed see, like, if we will keep pushing in this direction, if that will be the dynamics. And so another point was about the substitution, right, between that non-banks do not provide enough substitution. Here indeed can be external options. So either what you mentioned, these cross-border effects, but this unfortunately we wouldn't see probably, right? And what we can have a look at if companies are public, right? So they have access to the capital market. So that could be another substitution channel. So I think I stop here. Thanks again a lot for all the comments.
Do you want to add anything?
Yeah.